You guys have probably all heard of due diligence, but you may not have heard of pre-due diligence, which is the shit that happens before you get into due diligence. So that's what we're going to tackle today. Buckle in, and we're going to walk through the acquisition phase before you get something under contract. So during due diligence, you're going to be like the fucking Sherlock Holmes of real estate. You're going to be examining every nook, every cranny of the property in question. You're going to be looking at the property's health, the financial background, the zoning rules, the environmental factors, you name it, the whole shebang. Your goal here is simple. You're trying to sniff out any of the red flags that are lurking in the shadows. The deep due diligence dive is going to help you determine the property's true value, and it's going to identify any challenges or opportunities that you might not have seen. Think of it as your safety net. It's going to allow you to make better choices, probably sleep better at night, and sidestep any potential problems before you even commit to buying the property. So like I've stated before, when you're buying properties, they come in two different flavors. They're either going to be on market or off market. On market properties usually come with a marketing package. They're going to come with an OM, the pretty shiny package that's going to try to lure you in. Or you're going to find off market properties that somehow you got the seller's information or the lead came to you in whatever form, and they're probably not going to be as researched. They're probably not going to have all the information that you need. It's going to require you to ask for all the due diligence materials that are owned by the seller, and you're going to have to do a lot of digging yourself. You're going to have to figure out the demographics, do a market analysis. You're going to have to figure out the rent comps, the sales comps, pretty much everything. So if it's an on-market deal, what you want to do is you want to look through the OM. This is the car salesman pitch. It's going to highlight all the positives and hopefully make you fall in love with the property. So once again, when you're looking at an OM, there's a couple things that you want to look at. You want to look at the size of it, the total square footage of the property, and maybe in the individual unit areas. This is going to help you gauge the investment's potential. How big is one tenant relative to another tenant? Are they taking up 50% or more of the space? Hopefully this is a multi-tenant property. You're going to want to look at the construction year. You want to know the age of the structure. Look at the renovation history. Understand the past renovations, the past upgrades that the seller did. What's the current condition of the property? Is it distressed? Is it turnkey? What are the immediate needs of the property now? You're also going to want to take a look at the area, the demographics here. You're going to look at the neighborhood quality. Are there any development potentials? What amenities are there? How desirable is that market? Then you want to look at the people within that market. How many people make up that metro? How many people make up that MSA? How many people reside within a 3 to 5 mile radius? What type of age group are they in? Are they in the younger crowd? Are they the older crowd? How much income do they make? Are they on the lower end? Are they on the higher end? This is going to determine whether or not the tenants within your center are going to have a successful business. You can find out some information about the loan, namely the loan assumability, if the existing loan on the property could be assumed, and it might even give you the terms of those loans. It could also give you the job market, the stability of it, if it's growing or not, who the major employers of that region are. Then you want to focus on the tenant profile. What type of tenants are in here? Are they credit tenant? Are they national tenants? Or are they small mom and pop tenants? Look at their lease terms. Are they expiring soon? Or do they have a couple years left? Or are they going to be there for the long haul? When did they start the lease in general? How long have they been there? Are they sticky? Now, it's great that you have all that information with an OM if the property is listed. However, a lot of times when you find off-market properties, you might make a little bit more of a spread on those without having to pay brokers, namely because of the additional headache that you're going to have to deal with. Because you're not going to have all this information that I just listed that's already within the OM. You're going to have to go out and find that information yourself. All that within the OM should give you a good solid start in order to get a feel for the property itself, or a picture of what the investment will look like. Once again, if you don't have that info, you're going to have to find it yourself. After you find it, you'll be able to better evaluate and or get that pick. So off-market properties are probably going to set you a couple steps behind. Now, most importantly, with every single property that I come across, the first thing I need is the address. Why? Because I want to Google the address. I'm going to unleash the power of Google Maps, and I'm going to do a virtual walk of the area and learn about its location. My first step of doing this is doing a 30,000 foot view. I'm going to zoom all the way out, well, not all the way to where you can see the globe and shit, but out enough to see where the closest MSA is. What is the biggest city that it is nearby? And I want to understand where it is located in regards to that city. You know, how close is it to the highway? And in which direction is traffic going, or commuters going? Now, after I kind of get that full picture of where it's kind of located, if it looks like a primary, secondary, or tertiary market, I will zoom in even further. So I take it from a 30,000 foot view and I slightly decrease it, down to a 20, 10,000 up to a street view, right? I want to see big picture down to granular. Once you're at like roughly, 5, 10,000 foot view, you're going to be able to see where it's located, where the major corridors are. What is it nearby? How much residential space is there? Or what's the population density or residential density? Are there other competition around? Is there a Starbucks nearby? Is there a big fast food chain nearby? Everything. That'll give you a picture of, who's in that market, what type of tenants they are, and gives you a general feel for what your potential property could do. Now, after that, you want to do a street view. You want to virtually walk the neighborhood. What I generally do is I assess the conditions of the street. Look at the cars. Like, what do they look like? Are they pretty scrapped up? Are they brand new? Look for lease signs. Look for roof conditions, parking conditions. Look for intersections, any amenities. Once again, the surrounding businesses. Is there Chick-fil-A? Is there, Starbucks, McDonald's, whatever? Where's the traffic going? Is it going towards this way? Is it going away from it? Is this property not even seeing the light of day? And overall, you're going to be able to get some pictures of the overall property condition. Once again, Google Maps is not completely perfect, but it does give you a good running start without having to physically be there. Now you want to dive a little bit deeper. You want to get some information on the demographics, right? You want to double check the data that's provided by the seller or the broker. You can use Google. I like to use citydata.com. And if you want to get crazy with it, go to Census, the census.gov website, and it's going to tell you population trends, household income, tons of data. It'll even give you job growth and economic stability data. Job growth is important. If job growth is either stagnant or increasing, that is typically some of the stuff that I look for. If it's declining, people are going to probably be moving away, so that's not going to be good for business. You don't have customers buying products. For retail properties, you're probably going to be focusing on vehicles per day, or VPD. Retail and office properties, this is probably more important to those type of asset classes versus industrial properties. Look for, median household income. What does that number look like? Is it on the lower end of, every state's going to be a little bit different, but you have to know what the minimum wages are for certain states and what the demographics look like. $40,000 a year in income might be normal or the median in some states, where it could be the lower end for other states. In California, I'm pretty sure you got to make $200,000 in order just to survive. So that's probably the lower end, right? You also want to check on the crime rates. Use crimegrade.org or neighborhoodscout.com to check out what the crime and violence in the area is like. You don't want your shit getting vandalized all the time, right? You want an environment where tenants are safe and consumers are going to be safe. You can even go and look at, the schools in the area. What are the quality of the schools like? How many stars are they on Google Review? What are the businesses' reputations, right? Go on the Facebook and check the local groups out, see what they're saying. Though a lot of times you're going to get a lot of info from just all of that. And after you do all that, you could even call the broker. The broker is going to give you a decent amount of information as well. What you want to do is you want to gather a little bit more intel on the property. Ask about the ages of the mechanicals. I always ask about the big ticket items. The roof, the HVAC, the plumbing, the parking lot. How old are they? When were they last maintained? Do you have a list of CapEx items that you've done in the past? Last time the parking lot was resurfaced or restriped, is the property professionally managed? And I always ask for a rent roll and a trailing 12. Remember, this is way before we even get the property under contract. This is us kind of testing the waters, dipping our toes in the waters to figure out if we like the area, to figure out if the numbers make sense. And speaking of numbers, once we get the rent roll and the T12, some small minor financial information from the broker, we're going to have to run a pro forma. A pro forma is essentially a financial statement that outlines what the property looks like now and what the projected income is, as well as the expenses and profit. So it's going to hopefully help you make an informed decision of whether or not the property is going to meet your own investment goals. So let's switch gears. Let's say pre-due diligence, everything checks your boxes, everything looks good, and you want to purchase the property. The first thing you're going to do is submit an LOI, which we've talked about previously. I'll link the episode in the show notes. If your LOI is accepted, now you move into the purchase and sale agreement, or the PSA. Once again, I'll upload the episode on purchase and sale agreements in the show notes for you guys. So when you make your offer, you want to understand what the seller values the most. Is it price? Are the terms important to them? Do they want a quick closing? Do they just want a sure sale? That way you can structure your offer accordingly. The reason why I say that is because, there's a lot of times you can get really creative in here, and I'll do another episode in the future on some of the creative things that I've done in the past in order to get the deal done. In traditional financing, you're going to go the standard route. You're going to go with the bank, conventional loan, whatever the terms the bank give you. And when I say creative financing, it's a whole hodgepodge of things. One is seller financing, where the seller finances all or part of your loan. You can assume a loan, you can do a master lease, things like that. Once again, I'll get another episode on that. If you guys are super interested, let me know, and I'll get it out even quicker for you. Some of the key things you want to keep in mind, and a couple value tips for you guys when you are doing your offer or negotiating, right? So in your purchase and sale agreement, there's going to be a section that highlights the due diligence period. It's going to depend on how long it's going to take you to get through that period. Usually sellers are going to want it to be shorter, roughly 30 days or so. Personally, I think 45 is ideal, although I do think it's somewhat short. I typically shoot for the 60 range because there's a lot of things in that due diligence period time frame that are out of your control. So if you can get 60 plus, that would be great. But what you want to do is specify in your due diligence clause or due diligence period clause that timer starts when you receive all of your requested items. This will help avoid any delays. And alongside with that, you want to make sure that you have adequate extensions in your purchase agreement in order to cover for these unexpected situations. Whether it be financing, whether it be a report that's taking longer than normal, whatever it is, it's always good to have some type of extension baked in for you to be covered so that you can get your earnest money back. As much as you can, try to research the seller. Do a little bit of stalking on him, her, what have you. Check for, anything that you can find. Usually some of the things that stand out are back taxes or ongoing litigations or whatever. But in a sense, whatever dirt you can find, hopefully it will strengthen your negotiation position. It will give you more info on why the seller is selling. And if you find that they are motivated to sell, you have a little bit more leverage when you're negotiating. And the last value tip that I have for you guys is when you are sending out your purchasing sale agreement, make sure you include your due diligence checklist of all the items that you need up front. Now, a lot of times, every seller is not, or every owner might not have all these things. So you're going to have to be a little bit lenient here. So this essentially will allow you to be transparent to let them know this is what you need. And if I don't have all this, my due diligence period has not yet started. So in a sense, it puts the ball in their court and they have to speed it up. Once again, a lot of times the owner and or seller is probably not going to have every item. So you're going to have a system where, you know, when they present you all of the documents, you would have to waive certain things. Just keep that in mind for when the time comes. And that is all I have today for you guys on pre-due diligence. It's going to be a lot more complicated than this, but hopefully I've summarized it enough for you guys, gave you a solid summary of how the process kind of works and what you need. I hope you guys found it helpful. Let me know on IG, leave me a review, whatever. Until next time, Wonton out.